Good morning, everyone. Mike and Corey here today. We're going to talk about three topics. Google came out with earnings, disappointing. Disney came out with earnings, projecting subscribers down, disappointing. And Corey's going to take it from there and talk about buying the dip. I don't know if he's going to talk about stocks or overall the market buying the dip, but it should be interesting.
Work?
Does buy the dip work? Does buying things on sale work? As long as they go up in price, it does. So we'll talk about that. Must remind you, this is a financial education presentation. You must do your own due diligence on anything that you hear in this presentation. More disclaimer information can be found on ankerstarwealth.com, and the opinions expressed are mine and Corey's alone. So let me share my screen. You know, when you think of stocks that you use, Google, Alphabet, how often do you use that? I bet you I type Google or G. I just have to type G in my browser, and at least 10 times a day. And then even on my phone, I've got the Google, and and I know there's other competitors out there that do search and things like that, but Google is the brand that owns it. So they came out with their earnings and they missed. So revenue only $96.47 billion versus
Are they
the
really doing almost 400 billion a year?
Yeah, see, so yeah, I mean, huge amounts. Earnings they beat by 2 cents a share. YouTube, there's another thing. I don't use tons of YouTube, but we put this thing out there on YouTube, so we're using YouTube as well. Google Cloud revenue and
Mike,
acquisition costs.
Mike, you know what's important about that YouTube revenue number? Do you
What?
know?
What is that?
It's bigger than Netflix.
Yeah. Well, and I've got Netflix as well, but we have so many things that we can watch on our screens, phones, televisions, computers. It is just amazing. So Google comes out with that. Their stock is down. I think it said 9% in off hours. They had 8%. But what I want to do is step back because this is one of our core holdings in our models, and will continue to be. This did not, think of the quarterly earnings as a report card. It's a report card on our student as they get older and more mature. But when we take a look back, and I always like to look at this is a 1-year chart. So you can see it was up to like $205 a share, and then now it's dropped down to $190. But when you take a glance at this 1-year chart, is this a company you would like to own? If you didn't know anything about it, you'd say, oh yeah, because I would have bought a year ago at 145 and it's up to 190. And so whatever, calculate that 30%, 25%. I like that return. Is it without dips? Certainly not. I mean, look at that. Like it went up almost, it was at 190 back in July of last year. So it's really flat from there, but look at way down, way up. Great company, will continue to be used. I have seen some things where other countries, I don't think the United States yet is looking at it on a monopoly. Like, I don't even know how you could have a total monopoly on like, oh, that's search engine. Unless you partner to put it on platforms. The one thing I will say with Google is, as long as it's going forward, and you as a user, me as a user, I don't pay anything. Like, right? I don't search something and it says up, you owe us a quarter. So what happens is anytime something like that happens, think of it as if you aren't paying for a product, you are the product. So once again, our eyeballs, my eyeballs are the product Google is selling to advertisers. So that's really how they make their money. So that's Google. The other one that came out, and this is not in our models, Disney. I do have Disney Plus streaming.
Hey, Mike, on Google, I think the market is kind of punishing them a bit because of their $75 billion capex projection.
Yeah.
The earnings were
yeah.
I mean, not
solid.
Not something. Well, here's the one thing about the earnings is they slightly missed, I think, on the cloud
Hmm.
growth, but Microsoft just did the same thing like 2 weeks ago. So I think that was sort of in already or understood, but that 75 billion capex is I don't know. I think the mark, but you know, I mean,
This,
what? You're mad at your company for investing too much in their future growth? It's like, I mean, I don't mind. So
I think part of it too is when you start slicing and dicing everything, and I get it. When you're a multi-trillion-dollar company, you do have to report more than just overall revenue, overall earnings. It's kind of like as a student that we're following, if you say I'm an A student, but then they're like, well, you got an A in you got an A in shop class and an A in gym, but you got a B in math. That causes some concern. So they do break it down, and the more you break it down, the more you're going to miss somewhere. So, anyways, not concerned on Google. Um, Disney stock that we do not have in our models, it gets picked up in other places. Um, Here's the biggest thing that hit them is really a 1% decline in subscribers. So if you remember, Disney was kind of flat for a long time just on parks, and then they decided to get into the streaming game. And my kids were excited. I was excited because I like Marvel and a lot of the Disney movies. So that caused a lot of growth. Guess what? They're starting to mature, kind of like, I want to say kind of like Netflix has went through their ups and downs, and there's Amazon Prime has subscribers, and there's only so much time you can watch TV, and then you throw in free content like Google, free kind of, um, and you see like Disney's finally hitting a maturity point here with their subscribers. So as far as the earnings, I'll scroll down. They beat earnings pretty well. $1.76 compared to $1.45 expected on revenue, 24 some billion, a little bit higher, just a little bit. But just that, wow, we raised our prices, which they did, which is fine. Still worth it. Didn't raising the prices a couple bucks, or didn't cause me to cancel my subscription. But it's now I'm losing some viewers, and Disney stock is off a little bit more than 1%. It's down 1.5%. But here's another one. Now take a look. This is a 1-year graph. Now, would you have liked to have been Disney this past year? Unlike Google, this thing is basically flat from last March. And at one point it was up. And so if you bought it in the middle of April of last year, actually it's basically flat for a couple years. Now, if I go back to 5 years, we can see that at one point Disney was even bigger. Came out with the parks after COVID. Went way down at COVID, shot up because people were so dying to get out of the house, and then since then, Disney has not done well. So, that's Disney. Now, turn this into buying the dip, and I'll let Corey talk about it. I have
should we
some
buy the
opinions.
dip?
Buy the dip. Remember, didn't you say you were going to talk about buying the dip? Not
I'm
of
talking
Disney.
about buying the dip. Should we?
Buying the dip. So I have some opinions, but I'm gonna let Corey express his first. I don't want to influence his opinions, but I definitely want to weigh in on buying the dip.
Okay. Well, so and of course, want to recognize Ben Carlson. I'll have both of his books on my growing bookshelf in just a few days, Mike. So hold on for that. But someone wrote into him. They keep a pretty large bond position, and they intend to convert that to stocks when they get a dip, a 10% dip or a 20% dip. Is this a good strategy? So it seems like it makes sense, but let's take a look. What percent, and this is all Ben Carlson's work, so just really want to give him all the credit for that. What percent of the time do we get a dip, or are we even in a dip? So 50% or worse, we only get that 0.1% of the time. 40% or worse, we get 2.3% of the time. 30% or worse, 5% of the time. 20% or worse, 16% of the time. at 10% or worse 36% of the time. And then we're at all-time highs about 8% of the time. So roughly 1/3 of the time since 1950, we've been in a drawdown of 10% or worse. And then 2/3 of all years experience a 10% drawdown. So there are plenty of opportunities to buy the dip. However, a 20%, if you're like, you know what, I'm going to wait till the market's in a 20% drawdown to buy, well, you might have to wait 6 years during some instances to get that. The S&P has experienced a double digit, so 10% or worse drawdown in 6 of the last 10 years. 2 of those years, we did get to that 20% drawdown. So let's look at how long we have to wait between these dips. So the blue bars are the number of months between 10% pullback. So the longest, if you're like, I'm going to wait for a 10% drawdown and you picked the wrong time, somebody would have had to wait 84 months and they would not have wanted to miss those 84 months of being in the market. You can see quite a few times. There's been about 20 instances where you had to wait a year or more. And then, 20 instances for a year or more. And then, of course, that 84 months, 1990 to 1997, 7 years without a 20%, without a 10% drawdown. And then what if you wanted to wait 20%? For a 20% drawdown, you're having to wait multiple years almost every time. If you're this guy here, maybe you get lucky or maybe you get unlucky. But do we invest based on luck? I wouldn't recommend that. So, he recommends pick your asset allocation, rebalance, and stick with it no matter what. All right, Mike, what do you think?
Okay, so here's my 2 cents on buying the dip. First of all, I'm glad he talked about the S&P 500 because buying the dip for companies is dangerous because sometimes that dip never comes back. So buying the S&P 500, I certainly agree over the long term that's going to go up. The article is very accurate. If you wait for a 10% drawdown or 20% drawdown, you might be waiting a while. So you might say, well, I'm going to wait for a 10% drawdown before I invest, and the market goes up 20%, and then it comes down 10, you say, I'm in. Well, you just lost 10%. You think about that mathematically. But there's always chances to add risk. The other thing with buying the dip, if you're a seasoned professional and you're like, okay, I'm fine with it, that's one thing. It takes courage to buy the dip. What if the market goes down 20%? The economy goes into a recession, inflation is up, the market goes down 20%. Do you have the courage to buy the dip then? Because what happens is a psychological thing that says, wow, the sky is falling. How can I put my money in now? It's going to keep on going down. I've actually seen this with individual stocks. When Nvidia hit $150 a share, I was getting calls. Let's put more money in. And then when it went down to, let's say I think it was down to 103 at one point. And I was like, hey, do you want to put some in now? And they're like, well, let's hold on. It's come down to 103. I'm like, yeah, but it's the same company. It's on sale. So buying the dip takes courage. Plus, if you say I'm going to buy on a 10% drop, you see, sometimes it goes down 20, sometimes it goes down 30. So if your trigger point is 10, you're like, oh, down 10%, I'm putting my money in. And this is one of the times the market goes down 20 or 30. You're going in, right, is to sit down through another 10 or 20% drop. Can you sit through that? That's painful to go through. So, I would just say, overall, buying the dip, it works kind of. Certainly when somebody puts in new money, I love when things are on a dip to buy, but to sit money on the sideline in cash or bonds, just waiting for a dip, I would either slowly put my money in, and then if you see a dip, put the rest in, but I wouldn't just wait for the dip. So that's my 2 cents. Corey, what have you done in your career? Have you done some buy the dips?
I do a mix. So, you try to own the best companies in the world. That's goal number one. And you can fish in different sectors, so that's all good. No problem with diversity. I like diversity. Um, Sometimes you're going to buy stuff like, you go to a Visa or a MasterCard. It's never on sale. There is never a dip, almost never a dip. Or if you do get a dip in like a Visa, MasterCard, Costco, just one of those, it's because everything else in the market is like in a huge dip. And
Mm-hmm.
then finally, you can get a Visa or a MasterCard or Costco mini dip. So that's an issue too, right? Is when you do get a dip, can you stay true to focusing on the right things and not the eye candy of, something like that? And then of course, um, keep your position sizes under control, right? You don't want to go too heavy on one thing. And you can use some technical analysis there. So let's say, like, what's something that's, dipped? You can,
AMD.
AMD, or I'm trying to think of one that came back here,
Oh,
like Amazon or Google, where you had a pretty big dip in 2022, but they've come back.
oh yeah,
You
yeah,
can
yeah.
wait until it stops making new lows. So you're not going to buy right at the bottom, but you see it has bounced from some level, possibly a level it touched years ago. You have to go look for that. And then it goes up. And then when it comes back down, it stops before that other low and then starts to go back up. So you get what's called a higher low. So you
Yep.
see that the buying pressure is starting to overwhelm the selling pressure. Do you always win with that? I mean, no, but that's one thing you can do to help protect yourself. Wait for a higher low.
Well, I will tell you right now, the stock markets are near all-time highs. While there's certainly companies that are down, not there's opportunities, but when you say S&P 500, now we are not in a dip. There's not a dip
There
right
is
now.
no dip.
Will there be a dip this year? I predict it. I'm 100% sure that
You think
at some point the market will come down something. I don't know what. It might go up 15% and then drop 5. But
right.
the market going forward, there will always be dips. I just wouldn't wait for them. So anyways, that's all we got for today.
That's
Thanks
it.
everybody. Have a good one. Bye.